In this lesson, we're going to take a look at how changes to the inventory affect the three financial statements and how you can answer related questions in investment banking interviews. Now, the first thing to note here is that when you get a question about how inventory going up affects the three financial statements, the first thing you want to ask them is, how are you paying for this inventory? Are you paying for it with cash or using debt or another source for the financing of the inventory purchase? And the reason is that depending on whether you pay for it with cash or debt, the accounting treatment here is different. Not everything is 100% different, but you definitely want to ask and clarify that in the beginning. So we're going to walk through this the first time by showing what happens when you buy the inventory with cash, and then we're going to show the debt scenario after that. So I'm just going to jump in and enter inventory changes by 100 here. And we're going to start with the income statement once again. So on the income statement, there are actually no changes. So when inventory goes up or down, there are never any changes to the income statement in the immediate term, immediately after the inventory purchase or sale has been made. And the reason is that, according to accounting rules, when you buy inventory, that is a purchase, but it's not recorded as an expense on the income statement until you sell the goods that are associated with that inventory. So until you manufacture that inventory into finished products and sell to customers, you're not going to record it under cost of goods sold until that happens. Keep this in mind because that's an extremely common mistake to make with interview questions, that inventory changes do not show up on the income statement until the goods that you manufacture the inventory into are actually sold. So no changes there. On the cash flow statement, no changes to the top part because nothing on the income statement has changed. Under changes in operating assets and liabilities, we have a change in inventory here. So this means that cash flow goes down by 100. Remember that when an asset goes up, our cash flow goes down. And so that's exactly what we see being reflected right here. So our cash flow is down by 100, no changes to investing or financing activities. So overall, the increase or decrease in cash on the cash flow statement at the bottom is down by 100. Now, moving to the balance sheet, what we have is that our cash is down by 100. We know that from the cash flow statement. And then our inventory is up by 100. So these two changes cancel each other out on the asset side. And so our assets number, our total assets number, remains unchanged. On the liabilities and shareholders' equity side, there have been no changes, so this remains in balance, and we have the same number that matches the asset side right here. So that's how you walk through what happens when inventory changes and you assume that you're paying for the change with cash. Again, the most important point is to keep in mind that nothing changes immediately on the income statement once you buy inventory. So now to change up the scenario a little bit, we're going to assume that we finance this 100 worth of extra inventory with debt instead of cash. So to model out this scenario, what we're going to do is we're going to keep this inventory changes by number right here, but we're also going to enter long-term debt changes by, and I'm going to enter 100 right here. Now we're going to go through the three statements again and see exactly what changes. So in the income statement, once again, nothing changes here. Now I want to mention this again because you might think that if you issue debt, you're going to see a change on the income statement. If you're paying interest on the debt, you will see a change eventually. But immediately after the debt is issued, you will not see any change on the income statement because you haven't paid interest yet. So just issuing or paying off debt is never reflected on the income statement. Only interest expense from the debt is reflected on the income statement. So moving over to the cash flow statement, nothing changes at the top once again. For changes in operating assets and liabilities, once again, we have this negative cash flow coming from inventory going up. So our cash flow from operations is down by 100. No change under cash flow from investing. And then under cash flow from financing activities, we have our long-term debt here going up by 100. And so our cash flow from financing is up by 100. Remember that if you raise debt, that debt is effectively giving you cash. So raising debt is going to boost your total cash flow and is going to boost your cash number. So inventory has caused our cash flow from operations to go down by 100. Our cash flow from financing is up by 100. Those cancel each other out. And so our increase or decrease in cash is 0 here, so our cash balance doesn't change at all. So moving over to the balance sheet, our cash number is unchanged. Our inventory is up by 100, and so our total assets are up by 100. Over on the other side of the balance sheet, we have our long-term debt number here going up by 100, and so our total liabilities is up by 100. So our total liabilities and shareholders' equity is up by 100. Our total assets is also up by 100, and so our balance sheet balances. So that's a quick overview of how paying for inventory with cash versus debt is reflected on the three financial statements. Again, the most important point to keep in mind with this type of question is that the income statement is never affected in the near term, the immediate term, immediately after you issue the debt or immediately after you buy the inventory. It's only affected in the long term when the inventory is actually manufactured into products or after you actually pay interest expense on the debt. After that, the rest of the changes to the cash flow statement and balance sheet are pretty straightforward. Just make sure to go through everything in the order that we went through: income statement, cash flow statement, and balance sheet, and that should get you through these types of questions.